And now I'd like to introduce Mike Bernard, Vertex's Chief Tax Officer, who will lead today's discussion with Nicole Bryant of Grant Thornton and Sue Haffield of PwC. Mike?
Thanks so much, Stuart. And it's good to be with all of you here again today. And I hope, I know the conference is just getting going, and this is normally a pretty popular session that we do here today. So glad to have you all on board. As Stuart said, I'm Mike Bernard. I'm the Vice President of Tax Strategy and Content and Operations as the Chief Tax Officer here at Vertex. So a lot of what I do is we do a lot of thought leadership in our group, but we also provide the content library for all the calculations that are going on in your sales and everything. So glad to be with you here today. I'm really glad that Nicole and Sue are here again from last year. And so Nicole, if you'd like to go ahead and introduce yourself, please.
Yeah, thanks, Mike. So just briefly, I'm Nicole Bryant, state and local tax principal with Grant Thornton. I've been having fun with state and local taxes for a little over 19 years. I started out my career actually on the government side as a tax auditor for 8 years. And then I like to say I saw the light and moved over to the consulting side. And really then for the last 12, 13 years been focusing on multi-state sales and use tax issues and anything indirect tax related.
Thanks so much, Nicole. And Sue?
Hi, everybody. I'm Sue Haffield. I'm a tax partner at PricewaterhouseCoopers here in Minneapolis and have a lot of experience. I tend to not say how many years because after a certain number of years, you can just say a lot. So I'm always looking forward to presenting at Vertex and look forward to being with you here today.
Okay. Thank you so much, Sue. Appreciate it. As we kind of move through, we've got a lot of materials today to present. And so first of all, just in terms of the learning objectives, trying to just take a look at what emerged from 2021. As you know, there was a lot of impact still to COVID to a lot of the states, so we're going to kind of review some of those things. And obviously, we're going to talk about some things that are going to occur in 2022, and then take a look at some significant federal and state tax cases that impacted a number of you here on the call today. This is just our session agenda, which is kind of a breakdown, and we've kind of covered a lot of these things. Again, we're interested in presenting the materials, but we also want to really see what your questions are as we move through some of these things. So as you can see, we'll focus on a little bit on COVID. We'll look at some of the things that are going on outside of the U.S. We also want to take a look at emerging policy issues and some other trends that we're going to talk about, namely audit trends, and then wrap up with some litigation. And with that, we do have a series of polling questions, so if you want your CPE, you need to answer these questions. So the first one we want to ask is, what is your company's announced policy on workforce model for 2022? So a lot of you have very different models, but we're just trying to get a sense of where companies are going. So the first one, we expect to be back in the office with safeguards. The second one is you're still remote, and your schedule is going to be flexible based upon your discussions with your manager. The third one is that there's going to be a set number of days that you're going to have to be in the office. And then the second to last one is that you're going to be remote as far as you can tell, at least at this point. And then the last one is we have a lot of customers, I know at Vertex, that never left the office or they only left for a couple months, and that's where you've been for the last, say, 18 months or so. So take just a second and hit one of those buttons. And I'm guessing, Sue and Nicole, with all of your customer base, you've seen maybe just about all of these things, haven't you, at some point?
Exactly. A little bit of everything. And I think one of the recent conversations that I've had with clients is it's a little bit of a moving target. Some had a summer date and that's pushed to fall. Now it's pushed to January 1. So we're also just seeing some variances there.
Okay. And so I assume the same thing with you as well. Yep. Okay. Okay, so we're going to go ahead and close the poll and get the results here. And wow, okay, it looks like the dominant ones here that we're showing on the screen is basically that you're still remote, and it looks like you're going to be able to work things out with your manager, which is the second one. And then the other one looks like the dominant one now is just there's a set number of days that people are going to have to go back in. So, okay. Appreciate everybody answering that poll. Thank you very much. And then, so Nicole, I think we'll go ahead and we'll start it off with you then.
Perfect. Thanks, Mike. So just kind of keeping on that pandemic. So we were here a year ago talking about everything that we were hearing from the states in regard to the pandemic. And, just to say, we did see that interest and penalty waivers did continue into 2021, not as much as the sales tax deferments that we saw really early on in the pandemic in that first kind of spring and summer, but some interest and penalty waivers. And those are most often tied to any sort of state of emergency that maybe a state was linking those to. So, those are generally going to be wrapping up here at the end of December 2021. I would guess same with any of those temporary suspension periods. So those states who did announce what they were doing with regards to nexus and withholding purposes. So if they had remote individuals that were really due to the pandemic, they were not enacting nexus and going after those companies for that. We did see some of that extend, some of that ended, and then some of those states were always silent to begin with. So that's kind of playing out on an audit or controversy angle. We do have government offices are starting, some opened fairly quickly, kind of the same with the where we were working. It all depends on the state you're in. I do know I have auditors that are contacting saying that they're open and they're open to come into the taxpayer's business, and whether or not that works for your company may depend on your local restrictions within your county, city, state. One of the other things that was noted is just when you have, appeals going on and you have different appeal conferences, a lot of those transition to, remote, webcast, telephone, and we're starting to get more of those transitioning to in-person as well during this third quarter of 2021 and later. And one thing that I thought was a real benefit during this period of time is really more on the administrative nature of those e-signature options. So those states that require a wet signature on different documents, including POAs or audit assessment acknowledgments, that really has made it a lot easier on individuals to turn things around more quickly. But I would say, New York they did allow it for a point in time, and they are back to the wet signatures. So New York is not one of the states that has extended that for us, unfortunately. And then when we think about legislatively what we're seeing, we are still seeing some benefits. Colorado had an interesting one that was specific for the industry that I think we can acknowledge was very hard hit. Different restaurants, caterers, food retailers, and they were allowing a special deduction during these summer months in 2021 for June, July, and August. And what they're allowing is a deduction for the retailers to take on the state portion, and then those retailers could then retain that sales tax that they already collected. So they receive that benefit. We saw similar legislation with regards to PP&E be enacted, say in Virginia, and then vetoed by the governor in Michigan. So those are going to be where a qualifying business, any training or personal protective equipment purchased by that business could be sales tax exempt or not. And then in my fair state, I'm located in Seattle, Washington, and we had some legislation given how, generally Washington gross receipts for its B&O tax is very aggressive as far as what is included in that for a B&O perspective. But the state did issue emergency, where they said the emergency financial assistance grants with regards to the pandemic with a national or state emergency are exempt from the B&O tax. Now, those funds and how you use those funds, so say you use those funds, that did not apply to any purchases that were made from those funds. They were still applying and imposing sales tax on any of those types of PPE purchases. This kind of brings you to our thought of where are we now? So where are we in the first 3 quarters of 2021 compared to where we were sitting for those first 3 quarters of 2020? And, as we would expect, there's some surprises and not so surprises between the different states. And this is really showing the total state tax collected during these periods and the overall change between those fiscal years in 2020 versus 2021. You see some really, really big percentages for some of those states. And then, Hawaii, North Dakota, Alaska, certainly Hawaii is not surprising given the tourism industry and how that's impacted them over the course of time. I was also at a recent tax conference where there was someone located from the Nevada Taxpayer Association, and they were talking about Nevada's live entertainment tax. And it took a hit of 97% of what's normally collected for that tax. So definitely, depending on where you're located, some big impacts going on in some of these states. Swings in both directions, really. And so that's kind of moving into now some of the topic on digital service taxes. And before we talk about the legislation that we saw here in the US in 2021 and how that varied or didn't vary from 2020, we thought it'd be good to really give you an overview of what else is going on in the world, because this challenge for that we're seeing with regards to the digitalized economy isn't just here in the US, of course. It's a global challenge, and we're seeing a lot of discussions on this in a global nature. And under the current international tax rules, the corporate income tax paid by multinationals is really based and has been based on where the production occurs rather than where those users or consumers are located. And so we've seen the Organization for Economic Cooperation and Development, or the OECD, has really been working to level that tax playing field from a global perspective with its BEPS action plans. And really, this diagram here that is showing you, all of these sorts of digitalized revenue streams are in scope, both really in the US and globally. And, we've seen the European Commission tried to put out some tax reform, and a consensus was not reached. A number of countries have decided to take matters into their own hands, and they have implemented interim laws. So waiting to see if some consensus can be reached, but then really looking at what they need to do right now for their individual country. And a lot of this is that move to where the users and consumers are located. So if we want to take an example of a few of the countries that we're seeing in particular, really, so here we have, there's many countries who have either proposed or enacted some, but I just picked a few here as an example. And really in the UK, what we're seeing is a 2% gross receipts tax on specific digital activities, and that's based on UK users. And the UK is modeling it based on different search engines, social media platforms, and online marketplaces. And then we have Spain, which is a 3%, and that's really leveraged on looking at where the end users are having this essential contribution to the value creation of overseas business. And they're more focused on online advertising, but still that intermediation services and then sales of data that's generated from users. We'll hear more about that on the US side a little bit later. And then finally, my last example is Italy. And really the thing with Italy is it was the most aligned with the EU DST, really looking at that 3% tax rate with different thresholds based on both global and digital services in Italy. And then when we think about, while these countries are doing this, we have the OECD, which is really looking at providing a framework. And there's two pillars of approach that we've been looking at so far. One of those, which is, again, going to sound very familiar to us in the US, is no longer requiring a physical presence for a country to have the right to tax, and then creating some global minimum level of taxation. And so as of this summer, we had 130 countries that approved the framework for international tax reform. There were, I believe it was 9 countries that did not accept it. And then notably, the countries that have the strongest reservations, they've signed on to the framework, but the strongest reservations are going to be Ireland, Luxembourg, and the Netherlands.
And so Nicole, I know you're going to talk about the U.S. digital services taxes coming up here too, but I understand in this negotiation with all of these countries that one of the sticking points are these digital services taxes by some of these governments that you've mentioned here. And I believe in the negotiations, there's talk about withdrawing these taxes, which I think could put our state level taxes and then our federal government, if they're saying, hey, France, you can't have your tax, then what's the likelihood of Maryland's tax, for example, to survive if the federal government is at odds with the state? So I think that's going to be an interesting thing. Of course, we don't have a full agreement on all of this yet, but I do understand that these countries are looking at possibly withdrawing their taxes.
Yes, that's a good point. And some of them, I think, had that originally in mind and were just doing it as an interim because there couldn't be an agreement reached. And then I think some will be forced to, which maybe they like the way they designed theirs, but maybe forced to later on. Yeah, that's a great point. So moving to the next polling question, you should see this pop up soon. So as you look forward to 2022, which of the following issues is most important to the transaction tax group besides meeting statutory and regulatory tax changes? Is it trying to automate as many manual processes as possible? Is it supporting the business groups with their needs? Is it trying to recruit and retain our tax professionals? Having adequate funding to support the tax department IT environment initiatives? Or really, all of the above? It's really hard to just choose one, I think. Certainly automation, partly if you're having trouble recruiting, retaining tax professionals, you need to be able to do more with less people perhaps. And so that's where that kind of goes hand in hand with some of that automation, that's really necessary right now.
Yeah, I've certainly seen all of these issues at our clients as well.
Okay. And I'll go ahead and close the poll then. And
yeah.
So I don't know, Nicole and Sue, if you want to comment on those results. So.
Well, no surprising. I know I couldn't pick just one either. So I really agree with that.
I guess the one I'm the most surprised about is the recruiting and retaining, because it seems to me like there's been a lot of movement in the job market, really odd, especially during COVID. So I'm actually glad to see, although that could have been part of the all of the above as well. So
good point.
Great. Thank you. Okay.
So moving into that transition from global to U.S., and we have our own digital advertising taxes. And of course, we need to talk about Maryland as the front runner. So definitely this is one where we have enacted legislation. The date was pushed back. I would say that one important thing here is there was so much focus on the digital advertising tax that the digital products and the changes there were a little bit of an afterthought for some people. They were really focused on the digital advertising tax, but don't forget about that digital products as well. Some of the updates and amended provisions did show some exclusions from the definition, and it really is a very broad definition of digital products, one of the most broad ones, but there are some exclusions for pre-recorded live instruction by a school or institute of higher education. There was also some relief with regards to software that requires significant configuration would also be an exception. So really taking a close look at that from a digital products perspective. And then when we think about the Maryland's digital advertising tax itself, certainly it's one where, we see it, they have the statute that came out where it has these different tiers based on your global revenue. So that's an issue when we think about the higher tax rate being applied to those companies that have more revenue outside of Maryland. That's going to be one of the key, I think, constitutional issues in addition to the Internet Tax and Freedom Act. Also interesting is within the federal litigation, the state has argued that the court shouldn't hear the case. And one of the discussion points around that was because the taxpayer doesn't know yet if it's imposed on them or how it implies, and they won't know that until the regulation and the regulatory body decides. And when this statute was written and enacted, they really punted on several things, and one of those being the sourcing elements to this. And so if we kind of go to the next slide and take a look at the proposed sourcing regulation here, and it is looking at the apportionment is looking at the devices that are accessed over total devices, and then worldwide, and then you get to that percentage, and then it's a little silent on what base that is then applied to, but we're thinking based on the way it's written that it really is going to be based on the total global amount and not just US related digital advertising. And within the device, how do you know where your device is located? And if your device is in Maryland, it talks about using different things such as IP location, geolocation, device registration, cookies, and any other comparable information that the company may have. One of the biggest problems I see with this regulation is it does say that if the location cannot be determined, that it is thrown out. And, throw out is never a good thing in state taxation generally, because what that's going to do is it's going to throw out that those devices, and then you have a bump up in the Maryland apportionment because those are thrown out. One of the issues is, this is really tied to devices, so number of devices, and it's from an economic standpoint, it's not as closely tied to revenue. So, what is that, going to do with regards to this tax? And I think it's just when you see these sort of apportionment models, you're really thinking it sounds easy. Oh, okay, we have all these different options. So this seems easy. But it's not, with this complicated industry, with the different layers within advertising services that you have and the different players, it's certainly not going to be easy. And while, the media it's portrayed as, taxing big business, really it's going to have a trickle down effect to the smaller companies, to the users. It's not just going to necessarily stay within that big business, just the way the business model is with these taxes. So this regulation is out there, and the comment period is still open until November 8th to provide any comments about how this may affect your business. If we look at the other states with regards to digital advertising, and this list is much longer. Yes.
Oh, we had a question come in. It says, what is your opinion on purchasing these advertising services where the tax will be applicable to the vendor, and then providing as part of your advertising service to your client and charging a fee? Do you think this fee to the client could be subject to this tax? So it's kind of, I don't know, that's kind of an interesting question. It's where the tax will be applicable to the vendor, and then providing as part of your advertising services to your client and then charging a fee. So it's almost like you provide a service. I think in that situation, almost seems like those would be subject to sales taxes, I think. But I'm not sure it would be a tax, be yet another digital service tax on top of that.
Yeah, I don't think it would.
That's an interesting question. Yeah.
Yeah, the way that these are worded with regards to what's a digital advertising service and who it applies to, as far as, these have large thresholds of, 25 million, 100 million. So large thresholds that you have to overcome. And so I don't think that in that instance, if I'm understanding the question correctly, where it passes through, that we're going to have these layers necessarily of digital advertising, unless, like I said before, advertising is complicated in that, like you have one ad that you're seeing and there's multiple advertising players potentially within that revenue stream. And if both of those players meet these thresholds of revenue, then I think that's an instance where you could see this being applied multiple times.
Possibly, yeah, I would just add also that there were some of the state proposals where small businesses were raising concerns that, if they have to advertise digitally now, and if they were to get they were to have an increase in their advertising fees because the large advertisers would be trying to pass along this cost. I think it was Connecticut, a Connecticut legislator said, well, we'll just prohibit the passing on of the cost, which never works. I mean, then the price just increases. So I think that it's a really good issue, but I don't think there's necessarily resolution either.
Okay.
Right, and that's where when you think about this being this tax on big business, but it's gonna trickle down. Even if it's not a direct pass through, it's going to be taken into consideration with the pricing. So Maryland and some of these other states are thinking, oh, big businesses, but yet their businesses, their in-state constituents are also going to, have this economic hit to them at the end of the day.
Mm-hmm.
Yeah.
Thank you.
So great question. Thanks for sending that through, Mike. So looking at this with regards to other digital advertising taxes, this list is longer. It's definitely longer than it was last year when we were here. And this is a little bit of mix. I put them all on the same page, but just to make sure everyone's aware, this is a mix of those that are really this new gross receipts type tax where we see different rates that range from, 1%, 2% up to these high 10% taxes, for instance. So some of them are based on gross revenues from digital advertising services, and others are really just expanding the sales tax base. So a little bit of a difference there. To talk about Massachusetts for a minute is, in addition to having a bill proposed with regards to digital ad revenue, they also had a proposal to conduct a study. So they had a proposal that let's do a study, let's compare what some of these companies are paying now versus how much they would pay with this different enactment to kind of see some of those variables. But at the same time that they said, so it kind of felt like they were trying to gather some information first before just trying to enact law, but then they also had a proposal in place for that 6.25% tax. I will say that Massachusetts did look at what Maryland did and some of the flaws with the Maryland law, and they did address some of that. I think there's still issues with it, but one of the things that the Massachusetts proposal had was the same rate, so just a flat rate that's not dependent on any global out-of-state activity or revenue. And then in its proposal for the statute, they did include a sourcing. So not just leaving it up to a regulation, but a sourcing that was based on IP. I still think there's a lot of issues with that, and only having one methodology regards to IP. I think just the mechanics is still potentially difficult to implement and distortive, but they were trying with that. And then notably, my home state of Washington didn't actually get introduced, and that was going to be a sales tax expansion of the base. It was talked about at some of our stakeholder meetings and different discussions and beat up pretty badly, never actually introduced. But this is not going to be the end of this. We're going to see more of these. This is definitely the trend. You can tell legislatively that this and the other ones that we're going to talk about next is a trend. And some may be watching to see what happens with the court cases in Maryland, but we're going to continue to see this legislation, I think. And then moving over to what, again, sometimes digital advertising gets all the attention and all the glory, but I think it's important to note that we're also seeing some social media, very specific social media ad tax proposals. And this is looking at either advertising revenue from a social media platform and looking at that gross revenue and then applying a flat 7% sales tax on that. Or in some cases, it's a flat fee per user. So how many people in Indiana have a, Facebook, Instagram, Snapchat, TikTok? I have middle schoolers, you can tell. I know all of these. And it's basically a 5% per account holder per year if you have more than 1 million active users. So none of these passed, none of these were enacted. But again, I think this is going to be the trend that we'll continue to see more of these. The last but not least is going to be this one on personal information and data tax proposals. And so these are new taxes, generally gross receipts between 1% and 5% that are imposed on businesses selling personal information. the businesses collecting our information and then selling that information. It definitely seems like New York is really focusing on this one. Just in 2021, they had 4 different digital and data tax bills. And this really seems a focus of that state. So definitely going to see more from them. And generally what we see within these laws is that when they define what is consumer data, what would be encompassed within this is really any information that identifies or relates to and linked to a specific consumer would be included within these various taxes. And then
just so you know, we have another.
Oh, yeah.
Yeah. Oh, we just have a quick question, Diane. Thanks, Diane, for typing that one in. It says, do you think these proposals, I assume she's referring to these personal information data tax proposals in SST states, violates the SST rules on alternative tax rates? I don't know, possibly, I think. I think it's a good question. But I assume, I know Diane does a lot of work in SST, but I assume maybe I'm assuming they're looking at these things as well. So
I think it would depend if they're trying to be enacted as a sales tax or as a gross receipts tax, because the streamlined sales tax project really only deals with sales tax. It's a good point. It's possible to possibly argue that, as the states at the time were thinking that maybe they wouldn't allow like a special tax on something. But if it's a gross receipts tax, I'm not sure.
Okay. All right. Thanks, Sue. Appreciate that.
Yeah, so now we're going to switch gears. We're still in digital products here, but I guess this item is really more of a traditional digital product taxation type of item. Colorado became another state to impose tax on digital products with some legislation that codified their position in June of this year. And we already have a private letter ruling here. And at issue in this private letter ruling was whether or not if you sold a subscription that entitled the purchaser to free shipping as well as a number of digital products such as movies, books, music, and things like that, whether or not the entire charge would be subject to tax in Colorado as a digital product. And not surprisingly, Colorado looked at its bundled transaction rule and said that unless the taxable products were de minimis, and generally that's a 10% rule, then the entire charge could be subject to the tax. So I'm not really that surprised about the ruling itself, but I am a little surprised at how quickly they got it done, because this private letter ruling was issued in July. As you can see, the enactment of the codification provision was June 23rd, and the ruling was issued July 5th. So they didn't have a lot of time. It seemed like they were primed and ready with that ruling. And then our next item, or actually the next couple of items, relate to marketplace tax collection. And as you probably all know, under the marketplace model, the platform or marketplace facilitator is required to collect tax on all sales that are made by sellers on that marketplace. And Missouri and Texas were the last 2 states to enact marketplace laws that require this type of tax collection. So the country is now covered with every state that imposes a sales tax, and even Alaska now have marketplace provisions in place. Now, Missouri's doesn't take effect until January 1st of 2023. But when you think about how quickly these laws have been enacted, the first marketplace provisions were being looked at in 2015. And here we are just 6 years later, and we've got every single state covered by these provisions. But it's not surprising that we're seeing a lot of implementation issues, which I'll cover in a minute. So with respect to this Missouri item, though, a marketplace seller, I think, was hoping that Missouri would allow the marketplace facilitator to collect the tax and remit the tax, and basically have the law take place now rather than wait until January 1st of 2023. And the Missouri Department of Revenue came back and said, no, what you have to do is have the marketplace facilitator collect the tax and then give it back to you to remit on your own return. They did make note that starting January 1st of 23, that ruling would be null and void and the marketplace facilitator laws would go into effect. And then our next item is the Texas law. And the Texas law took effect on October 1st. But one thing that I think is really noteworthy on the Texas law is, as you know, if you operate in Texas, local taxes are collected on an origin basis. So if you have an intrastate sale, a Texas to Texas sale, the local taxes are collected on an origin basis. Under the marketplace law, the marketplace provider would be collecting tax on a destination basis. However, some cities were successful in filing a lawsuit with respect to the local tax sourcing provisions. And because that lawsuit was filed, the sourcing provisions in Texas under this law have been delayed. And based on how quickly the court case will move, the delay we're expecting to be at least until next year, June or July of 2022. So if you operate a marketplace in Texas, you'll want to make sure that you're aware of this special provision there. And if we go to the next one. So another marketplace issue that we've seen pop up in California, California is trying to address, and this relates to drop shipments. So if you are a drop shipper in California, you're probably very familiar with the idea that if you drop ship something to a consumer in California, but you actually sold it to a seller outside of California that did not collect tax on the transaction, you as the drop shipper are required to collect that tax in California. And if, since you don't have the retail price, California assumes a markup and you have to actually collect tax based on that markup as well. So the problem comes into play while the seller that you sold it to as a drop shipper is not collecting the tax, if they're selling that product on a marketplace, the marketplace provider is collecting the tax, but as a drop shipper, you wouldn't necessarily know that or have the proof of that. And so this proposal in California is meant to get at that fact pattern. And basically what it's saying is that a drop shipment scenario does not include a sale where you have collection by a marketplace. And I think this is a really good step in California, but I do see that there could be some potential issues where the drop shipper is still going to have to maintain some kind of documentation from that marketplace seller that says that they're selling their items on the marketplace. Otherwise, they're going to have to go to some measures when they, as the drop shipper, are audited to prove that tax was calculated and remitted to California on that sale. So I would say we still have to wait and see on what's happening with that one. And then in another California matter, you might be aware that California has gone back and assessed a number of sellers on Amazon that were using the fulfillment by Amazon model, which basically means that the seller would send their inventory to Amazon and pay Amazon to warehouse that product and then ship it and fulfill it from an Amazon warehouse. And the practice is that you might as a seller send it to Amazon in West Virginia, but it could eventually be moved by Amazon to California. And what California has done is gone back and assessed these types of businesses back to 2012. So prior to Wayfair, prior to the marketplace laws as well. And the basis for that assessment is that you have inventory in California, and that's clearly physical presence. So under Quill, you would have had nexus in California. Well, these taxpayers went to federal court, to a district court, to try to get an injunction on this practice by California. And unfortunately for the taxpayers, the federal judge said that this is not something that is in their jurisdiction. When there's a state remedy that's available, the Tax Injunction Act does not allow a federal court to be involved in state tax matters. So they're going to have to try to challenge this in state court instead. And now we're going to talk a little bit about the some things that I mentioned on the kind of the non-legislative front. I mentioned that we would talk a bit about some challenges and issues that we're seeing, especially with the marketplace model. I'm not going to go through all of these, but I did want to really point out the first couple here, and that's navigating the responsibility for other taxes. So the marketplace laws often only apply to the sales tax section of the law. So as you know, a lot of other taxes might be reported on that sales tax return. You might have the recycling fees, the 911 fees, food and beverage taxes, and things like that. So if a particular state law only was imposed, the marketplace collection was only imposed in the sales tax section of the law, then it leaves a question as to what happens with these reporting of these other taxes and fees. And what we often see is that the states will require the marketplace to collect the sales tax and report those sales, but then the seller is required to file a return to report the other sales. So there's this dual reporting responsibility. And then the forms aren't necessarily in line, so you can't always tell exactly, if you're not going to be reporting any of the sales for sales tax purposes, how do you get to the calculation of these other taxes and fees that need to be reported? So that's an issue that I really think we're going to need to see some additional work on. I'll also just kind of point out here the challenges that I think we're going to see from an audit perspective as well. I haven't seen a lot of marketplace facilitation audits, but the concern that I have heard expressed is if you are a marketplace seller and you sell products on your own website or even just at a store, and you've made a determination that your particular product is not taxable, but you sell it on the marketplace and the marketplace gets audited and a state decides that it is taxable, the marketplace settles that audit. Now you have a differing opinion. Basically, if you're selling on the marketplace, your product could be taxable, and you have really no rights to try to protest that item unless you work with your marketplace provider, and then you sell it on your own and you think it's exempt. And I think that that type of audit issue is going to become prevalent as we move forward with these types of laws. Now we'll move on to the next section, which is really just some trends that we're seeing on the audit front. And here, I just wanted to mention a couple of items, and then I know Nicole is going to talk about Washington. The Wisconsin item, we have seen Wisconsin be very, very aggressive at trying to look at a contract that is related to software as a service and recharacterize it as a telecommunication service. And of course, they would do that because Wisconsin does not impose tax on software as a service, but they do impose tax on telecommunication services. And the good news on this front is, although I've seen this happen for a number of clients here, telecommunication services, because it's a defined term in the Streamlined Sales Tax Project, where a taxpayer went to the Streamlined product, went through the process, and the Streamlined Sales Tax Governing Board has adopted the idea that Wisconsin cannot do this and remain compliant within the agreement. And so a couple of weeks ago, Wisconsin did indicate that they would follow SST's interpretation and no longer try to reclassify products that are SaaS to be telecommunication services. So that's good news. Another piece of good news is that we did see Texas reclassifying payment processing fees as data processing because Texas imposes tax on data processing. And we saw legislation that was effective October 1st to exclude payment processing fees from data processing to try to clear up that audit issue that people were having as well. And now, Nicole, I know you had some Washington items that we were going to discuss.
Yeah, and one
Hey,
thing is, oh,
Nicole, just really quick, we had a couple questions come in. One was is something that's been happening, I think, in a number of places, but it was basically, it says that they essentially, the question is that they sell a lot of their items for sale for resale, and then they have this administrative burden of meeting the economic nexus standards of a state, but yet there's no tax liability, and yet they have to go ahead and file a return. And I guess the question is then, is there any movement within the states to understand that the manufacturers and distributors and other people who have no tax burden still have to go ahead and file these returns? And I think what we've seen, I know what we saw in the Northeast was like, no, they still have to go ahead and file the returns, but I don't know what's going to happen in 2022. Have either one of you seen any movement to try and deal with that issue?
I do think some of the streamlined states are trying to look at some simplification and from that aspect. And then the other thing that I've seen, not a lot, but other thing that I've seen is if you file really low dollar returns, that eventually they might put you on an annual filing basis or something like that, so that at least the administrative burden is a little bit less. But it is an issue. I completely understand the frustration behind it as well, since it's really they're not getting any additional revenue.
yeah, and I know right when some of the states enacted, even though their statute said it was based on gross and not taxable sales, they were having issues with getting their infrastructure in place, and so some of the states were just saying, wait, don't register if you're not subject, if you don't have any tax to report. I think that's calmed down a little bit. That was just kind of in the initial flux. And then one of the other pieces of the question that James had was on the penalty side. And so the way that penalties apply can be different depending on the state. And so some states tie the penalties specifically to the tax due. And then other states may have it being a flat fee or non-filing fee. So that can vary a bit state by state.
Okay. All right. Very good. And then that other question, do you see that one, Nicole?
Yeah, I saw that. So are you seeing
Chris?
Are you seeing any states just denying first level appeals documentation due to limited resources without valid explanations? And then Chris noted Pennsylvania in parentheses. I haven't seen that, and I'd be curious on if they actually said limited resources as a reasoning, but I haven't seen that necessarily on an appeals level. And but I have seen some refunds come through with just a very quick denial letter with a long list of bogus reasons for the denial. So not as much on the appeals side, but I have seen some interesting responses from states on the refund side. Sue, I don't know about you on that question.
I've actually seen the opposite out of Pennsylvania, which is, honestly very shocking. But we had a client that had they got an assessment from Pennsylvania, but it was really late. Like, we thought it was over like years before that, and all of a sudden an assessment showed up, and we were successful in appeal, saying this assessment was issued well after the statute of limitations closed, and it was involving a VDA, so that made a little bit difference. We were a little bit worried that somehow Pennsylvania could go back on their VDA argument or something, but they agreed with us very quickly that we should have assessed this tax much sooner than we did. So had kind of the opposite, but it was kind of a resource issue for them as well. So very odd.
And it looks like sorry, Sue. It looks like Nikki offered a thought there too. It looks like that they filed a year of non-taxable sales, and it looks like Alabama closed their account as dormant. So, wow, good for you, Alabama. That sounds like a pretty good way to deal with it. So,
good intel. Thanks, Nikki, for that.
Thank you so much. Okay. Nicole, were you going to make a couple thoughts then here?
Yeah, a couple of thoughts just to be wary of, and this relates specific to the insurance business, and so I'm not going to go into a lot of details with this, but just to let it be known, impactful policy change. There could be more like this coming from Washington or different states. And that's where there was a longstanding tax determination case out there, which provided an exemption for activities that were functionally related to the insurance business. And so in some cases, when you have an affiliate, then it was deemed to be excluded. And this dates back to 1990. So a lot of companies were hinging their structure, the way they did intercompany, based on that determination. And then many actually had private letter rulings. In addition to just citing the determination, they also had private letter rulings on file. And Washington basically withdrew the determination and said, you can't rely on this anymore. We don't agree with it. We think it misapplies the statute. And they're being very aggressive for non-registered businesses. I feel like, or I've heard that they're applying it even. So this happened in fourth quarter 2019, and I've heard them really trying to apply that back to 2013 and historically. Okay. And then kind of keeping on that theme of things to watch out for and just things to be knowledge within kind of the controversy spaces, not just audits, but also VDAs. We're getting some pushback. So we've seen Texas recently not accept different customer affidavits with regards to self-remittance of use tax. And the state is actually asking for source data and documentation of a taxpayer's customer's use tax reporting. So they want all the underlying data and underlying source documentation with regards to their customers' use tax reporting in order to remove that from the VDA. That was new just overall, and then also new with regards to other Texas VDAs I've done in the past. And then just a quick note, we're seeing definitely a little bit more of field audits being conducted in some states. Washington, it still all depends. Sometimes they'll ask for contracts, invoices, detailed apportionment. Almost feels like they're doing a little bit of a desk audit, but then I've also had other ones that were still very quick and smooth. So just seeing some differences with regards to VDA activities by some of the states. So now that brings us to polling question. I believe this is actually number 3, but under most jurisdictions, under most jurisdictional sales and use tax audits, tax departments engage with auditors and agree upon a test audit period. What has been your experience in most cases as it relates to determining the number or amount of sample audit months? So what are you seeing in that? Do you generally agree on the sample months with some discussion and focus on that for the audit, or does it depend? Do some jurisdictions work with you on your sampling plan? Are some more contentious? Does the relationship and documentation really dictate how much information is provided? Or C, is there generally agreement and the issue comes with auditing a proper representation of sample of transactions? So kind of what is everyone experience on this front? I know one thing that I often utilize with discussing sampling is I go to their, if it's a state that has an audit manual or an actually published sampling plan, I've used that definitely on audits to go back to that and point the auditors, if they're trying to apply it in some other manner, I point them to their own DOR manual to get them back on track.
Okay. And I think we'll keep the poll open just a little bit longer because the buttons didn't populate right away and we got a lot of stuff in the chat. So we'll just hold on here just for a second. And I'm not seeing any. Okay. And if the buttons aren't popping up in the chat, then just send us something in the chat and tell us what the answer is. Okay.
Okay. I think it's working now.
Yep.
May have been a bit of delay.
Okay. Yeah. There we go. Okay. And then we're going to go ahead and close this poll, and then we have one more polling question.
So it depends.
So yeah, it depends. Yeah. Okay. All right. And then this would be poll question number 4, Nicole, if you could.
So this one relates to refunds. So as a best tax practice, businesses are generally conducting reverse audits of invoices issued to customers, as well as for vendor invoices submitted for payment to reduce any potential tax exposure. So this practice can significantly reduce or eliminate potential financial reserve entries. What are your reverse audit practices? Do you review both sales and use tax? Do you just focus on the review of sales tax? Or do you just review your use tax accrual and remittance? Or are you thinking, hey, we don't conduct any reverse audits right now, but maybe we should?
Okay.
So give you some time, push that out to get some responses.
A lot of times, I think it just really kind of depends on where, your issues are, don't you think? I mean, sometimes if you're strong in the procurement space, you don't do that, but it really kind of depends on where the investments are being made here. So,
and your complement of vendors too. I mean, if you feel like your vendors are really getting it, your vendors are getting it right, and especially post Wayfair, when more and more vendors are starting to be required to collect the tax, I could see that being a little bit of a difference as well.
Sure.
Yeah, I think historically there was a more worry about use tax. Are you properly paying use tax? And now it's kind of changed a little bit with so many vendors charging sales tax, but maybe not being familiar with the complex tax laws, misapplying the sales tax.
That's right.
Okay. And we'll go ahead and close this. Okay, so looks like both sides. Okay, so we're going to get to the litigation piece here. We might go over just a few minutes because I know we've got a lot of questions in the chat, and so I'll just Nicole and Sue will just kind of monitor that. But I'll try and move through these slides really quickly. Basically, I'm only going to talk about 3 cases here. The first one is Ohio versus Secretary Yellen. So if you think about, remember what happened back in March of this year, there was the Rescue Act came in, there was $350 billion that was mandated to the states. It flowed from the feds into the states. It was quite a bit of money. One of the things that was inside of that legislation was this thing called the tax mandate. And essentially what it said was the feds told the states, hey, look, you actually have to use that money to provide relief for COVID. The states, almost 26 states actually sued the federal government over this thing based upon the spending clause, but based upon the 10th Amendment, which says, hey, if you're going to give us money and it's going to be kind of wide open, you really kind of can't do that. That's different than giving you the feds giving you money for, say, Medicare or giving you money for transportation dollars. So it has to be much more targeted than it was. They were very successful. I'm just going to move these along a little bit here. And essentially where all of this ended up was on August, if you look at the very last 2 bullet points, on August 11th, the U.S. Senate decided to get rid of the SALT cap. That hasn't occurred yet because what happened is that provision, so it gets rid of the tax mandate, but that provision is actually tied up in the infrastructure bill, which is designated for highways and ports and those and bridges. So that hasn't passed Congress yet. That's different than the human capital mandate, which is the $3.5 trillion that you've been hearing about. Now it's whittled down to about $2 trillion. So right now, what states are doing is most of the states I think are just kind of holding on to this money, waiting to see if this thing is going to pass Congress. Otherwise, they've enjoyed some really good success. Ohio won their case in federal district courts. I'm sure the government's going to appeal it. Or may not appeal it, and then Missouri won a case also. So I think the states are going to go ahead and spend this money. It's important because the money was significant, and if you ever want to see the dollars that actually flow to each state, you can send me an email, and there's a really good source on that in the Tax Foundation. They actually did a study on that. Excellent. I'll move these slides along. New Hampshire versus Massachusetts. I think this is the state remote workers tax dispute. Obviously, we have a payroll product at Vertex, and so I just wanted to touch on this quickly. The original court of jurisdiction was the U.S. Supreme Court because it's a dispute between 2 states. They decided not to take the case. They sent it back to the lower federal court. We think the reason they did that was that the Supreme Court really doesn't like taking cases like this because they're really kind of an economic type of case. There are several states that have agreements. If you look at the New York, New Jersey, Connecticut area, if you look at Washington, D.C., Virginia, Maryland area, and then there's some states down at the bottom where they have some different sourcing laws. I think the idea here is that I would think that one principle of law that they're going to try time to get taxed in the state in which the service, in where you provide the service, not where those services are actually, where they're, benefited from. So this thing is still trucking along, but obviously a lot of you have made decisions about where you're going to withhold, and what we've seen a lot of withholding is the residence of where the remote worker is. And then lastly, just Oracle versus the commissioner in the state of Massachusetts. This is a refund case. Essentially, what happened was there were a bunch of software licenses where there was some over collection done for sales into Massachusetts. Those software licenses were deployed elsewhere out into the network of those certain companies. So there was a rebate done. And basically what Oracle did was they followed the statutory requirements of what they needed to do. The Department of Revenue had a different rule in which they thought it should have been handled a different way, and eventually Oracle prevailed. So again, sometimes you just have to fight some of these things where there's overreach by the Department of Revenue, and obviously this was a place where they actually won. And I think with that, we're near the end here. For those of you whose questions we probably didn't get to, we'll try and answer those separately, if that's okay with you, with Nicole and Sue. We'll just try and answer those, and then with that, we'll turn it back to Stu.
Great. Thank you, Nicole, Sue, and Mike. This concludes today's presentation. Any questions we did not answer have been collected, and we will follow up via email within 48 hours. On behalf of our presenters and Vertex, I want to thank you for your participation. Thank you, and enjoy the rest of your day.